There are incredibly successful, huge social impact and spiritual impact deals that have outsized financial returns. But the general public opinion is when you add social, the financial returns drop. And so getting around that stigma and understanding that if you're seeking the highest financial returns only, you have a great resource. There's a ton of opportunity to invest in market returns that have social impact. And that realm should be attacked and addressed first, because it's the easiest low-hanging fruit. That if you're not investing in a social business, that's a great place to start.
Welcome to the Feast Over Famine podcast. On this podcast, we're navigating the tension that we find where mission and profit collide. We're talking to CEOs, founders, executive directors, impact investors, and all of what we've identified as the global ecosystem of the social enterprise, business for transformation, business as mission landscape. We're talking to them about the obstacles they face, the strategic challenges they've been through, how they're funded, how they were started, and everything that's happened in between. We are trying to share their story in a way that's impactful to help us all to grow the social enterprise space for the better. Enjoy this week's episode with your host, Ryan Mahaffey.
Hey everyone, welcome to this week's episode of the Feast Over Famine podcast. Stoked you guys are here, and I'm really excited for this week's episode. We've had a few projects work with the Lernihans and what they're doing, and so I'm excited to have Tom and Greg join us today. We're going to talk about their fun, the work they've done, their background, and just some interesting pieces about their story and the way they approach this stuff. And I think there's some really cool opportunities to learn from that. So Greg and Tom, welcome to the podcast. Stoked you guys are here.
Yeah, thanks, Ryan. Yeah, excited.
Yeah. So you guys are, every time I talk to someone and you were looking for a connection point, you guys are for sure at the top of the list of, you were saying a minute ago, Greg, when we were preparing here, like the 1 degree of separation. You guys definitely have that. I mentioned you guys and everybody knows who you are. So I'm excited to hear the story about how you guys became kind of thought leaders in this space. I know you work a lot with Impact Foundation and all sorts of stuff. But yeah, why don't we start? Tell me a little bit of the story, like how you guys landed here, how your heart ended up saying like, let's go do this kind of crazy thing and start doing this. And then we could talk more about what the fun looks like and then get into some of the meat of it from there.
I think, that one probably come to me, Ryan. Let me start off. I'm an entrepreneur and first of all, I was in the corporate world for 20 years with a Fortune 50 company and had good training, et cetera. And a co-founder and I started out on our own in 2001 and built a security integration company called Convergent Technologies. It's been wildly successful. And it was great building a company from scratch. It's one of those basement stories. We're in the basement of a house, just the two of us. And went on to now be a global company. But back in 2010, 11, I started to feel the calling of doing something different. Yet I loved our company. Our company's wildly successful. There's nothing better than running your own company. And I read a book, it was a secular book called How to Change the World with David Bordenstein, and introduced me to this thing called social entrepreneurship, which I wasn't familiar with at all. And then for whatever reason, which I still can't explain, the Holy Spirit influenced me to go to Haiti. And I'd never been to a developing country. So I took 30 of our colleagues that were interested, and we spent a week in Haiti, and it changed my life and the outlook of what was important. And what happened is when I came back, we were already in a process of selling a percentage of our company in 2012. We had built a company that was a great platform for others to invest in. And so a combination of selling a portion of our company, going to Haiti, reading some books, I decided to leave day-to-day responsibilities, still on the board, still an investor of this company that's succeeding today, and started literally that next day after I slowly unwound. I started Googling impact investing, joined the board of a company called Impact Engine, which was secular, and started writing checks and listening to pitches. And I was an entrepreneur, didn't know a thing about different legal settings or convertible notes or safe agreements or any of that. But I thought the best place to start was writing checks. Yeah. And we made some errors back then, but there's nothing like sitting down across the table from an entrepreneur and listening to the story and writing a check. And so that started in 2013 from a secular perspective. Yeah. And then what happened over a couple of years you're talking about 1 degree of separation. Henry Kastner was the first name, or early on, right out of the gate, you got to know Henry. And so I called Henry and we got to become friends, et cetera. And I sat next to some people at different conferences, got connected with Praxis. And next thing you know, within literally, as soon as I heard about triple bottom line, I changed that moment, that second, from just impact investing to investing with a faith lens. And that probably was, I'm going to say, 8 years ago, maybe 9. I was probably into the year, maybe going on 10 now.
Okay.
Where we put a faith lens on it. First couple of years was really just impact investing. Didn't know there was a faith lens we could even seek.
Yeah. Well, and I'll stop you there for a second. So we talk a lot about, there's a lot of people in the church and just out in the world right now that, have an opportunity to get involved in this stuff where they're at today. You read a book and then just kind of got involved with what you were doing at your company. Like how fast of a process was that? I mean, you read that book, you took your team to Haiti. Was your team saying, man, this guy's crazy. He is on this whole philanthropic gig and now he's dragging us across the world to do this kind of stuff. Like, talk to me a little bit about that trend. And also that's you guys were at a successful point, but as an entrepreneur, that's scary too, right? You're taking new risks, you're going to new things. I mean, leaving day-to-day ops, like there's a lot that happened there that you kind of brushed over, but when you're thinking about someone listening to this, like, wow, I have the same opportunity to do that where they're at. Like, what were some of the big pivotal kind of moments in that season for you as you're making that shift?
Well, looking back, I probably didn't realize the Holy Spirit was influencing me, to be candid. And when I went to Haiti, I was literally scared. I was very uncomfortable. It's a lawless country. And when you're there, but I was amongst the poorest of the poor. We were only there for 8 or 9 days and worked nonstop and did everything wrong that you're supposed to do when you do a trip like this. And I've read all the books on Helping Hurts and things like that. They were spot on with all the mistakes we made. But at the end of the day, we were sitting with people that had never had a job, that were poor, had no food, and we were giving them clean water, and they were praying for us. And I remember that change and transformation of going, I'm chasing revenue right now and trying to be bigger. And that's still built in me. So that you know.
Totally.
When I left, I thought I was going to go into the nonprofit world and grant our money away, that we were successful through this exit. And what I learned literally in months is I think God's equipped me with business and leadership skills in a for-profit mind. That's just the way my mind is wired. If you're at 10 million, you go to 20. If you're at 20, you go to 50. If you go 50, that's just the way it works. And the skill set was better suited. And the nonprofit world isn't solving the problems I wanted to help solve, which is providing the dignity of work for people and to actually employ them so they can provide, income for their families and take care of them. And if there's one thing we figured out in running our fund is employment for the marginalized is the center of the bullseye. And I think that started back in that trip. And then the last point is my whole life, I wanted to have purpose. And so as a young man, I listened to your earlier podcast where you talked about some of your background. I wanted to make a difference in the world from the time I started Convergent Technologies. And I would used to joke with my kids, we're a security company. We're going to save the world. Protect the world was kind of my opportunity. Yeah. And now leaving Convergent to do what we're doing now, I really had that opportunity to use for-profit skills to help the marginalized. Yeah. And it was everything I've wanted to do. Yeah. Well, and one of the cool things I noticed in there is like, the pendulum swings pretty hard for people, right? They're like, I remember when I became a Christian, I thought, maybe you heard this in the podcast. Like, I was like, I'm a Christian. I need to sell everything, ditch my downtown Chicago apartment and move to Africa tomorrow. Otherwise, that's the only way to be like a good human now. And so for that pendulum swing so hard, you're like, wow, my eyes are open. I need to go do this. But I think maybe your pendulum, swung one day and balanced out a little, but you kind of arrived in that middle ground where you're like, oh, this is actually really, really good. And this is where I'm fit and gifted. And even challenge the status quo a little bit of what was out there and what people were doing, to not just go grant that money and to think about it differently. And I think that's hugely important. We always talk, our mission is to navigate the tension where mission and profit collide. Right. So right. It's a tension point. It's not okay, Greg, sell your company and go the total other direction and not do it. So I just think that's a cool story and a cool piece of it. So I guess talk to me and Tom, I want to get you involved here and hear part of how you got involved. Talk to me about where you guys are at today, and you don't have to go into the full theses because we're going to dive into some of those pieces, but I guess give me a little bit of a scope of,
how that all led to where you guys are at today and what you're doing and those pieces.
So it's obviously been a journey. We've been at this 7, 8 years, 9 years now. And that process has changed. When we first started investing, we, as Greg mentioned, didn't have a faith lens or any sort of component that was tied to our fund. But now we do. So we've got an ability to partner with a bunch of different ministries, a bunch of different nonprofits and for-profit businesses around the world. Our fund, about half the investments that we make each year are international, and then the other half are US based. But our core thesis is around supporting ventures that have an opportunity to employ families that need employment, particularly those in developing nations or struggling communities here in the US. And so that's what we seek to do. And that's what we feel called our fund has, driving to address.
Yeah. Awesome. It's very impressive that. So we've talked to a handful of funds and seen some, from VC funds in Silicon Valley, we know, to, small funds like what Eric Fast and Mark Phillips, we talked to them when they were getting rolling and stuff, which are doing awesome stuff. For those listening, can you give us a little bit of a scope? It doesn't have to be the amount of the fund, but maybe like a certain number of projects there per year, or the average size of investment or type of investment, whatever you're comfortable or feel good sharing. Like, can you give us a little scope of like where you guys land in that space, just so people
absolutely
know that?
So we're a family office. We operate with an internal capital. We don't raise any outside LP capital. So everything that we've been doing has just been, with our own resources. When we first got started, several years back, we were writing 1 to 2 checks, maybe 3 checks a year. And over time, the past few years, we'd made about 10 to 12 investments. In this last year, coming up on 2021, we'll make about 25 to 30 investments across the whole year. So our investment portfolios continue to grow, and we've now have about 115 investments across our portfolio with about 60 companies that we actively manage. So that gives a sense for the size of investments. And a scope of the investments from a investment size, we typically are investing in early stage startups where we're a portion of a raise. We're usually a player in that. We're almost never the lead investor. We're a small team, a small family that's trying to deploy capital in, sometimes very remote parts of the world, and don't have the access to staff to be able to complete due diligence that a lead investor would need to do. So we find ourselves as a component, as a source of capital for early stage ventures that are in social enterprises that have a faith lens to their business, and we can support and encourage those ventures with the capital investment.
Yeah, awesome. I'm going to try to remember all the awesome angles we can go on here. But the first one, like you talk about employment for the marginalized, right? Which I think is huge. Like we want to give jobs, not just give whatever someone needs. We want to do both. But I think that it's a super important thing. And this is more of an opinion question. Like, what's your guys' opinion on what's impactful for that? We had this conversation a few weeks ago, and I'm trying to remember the context of it, but basically saying, wow, we can like do microfinance, and that's going to sound like I'm taking a shot at microfinance here. And I'm not, although it wouldn't be abnormal for me to rock the boat a little bit, but like, the microfinance opportunity, like, let's just say we're going to go buy chickens for a small chicken farm. It's going to employ one person in a rural developing country area. Awesome. Like, I think there's a lot of value in that, but it's not pumping the cash in that's going to say, hey, we can hire 20, 30, 40, 50 people or more into that scenario. So talk to me, I guess, from the angle of your fund, but also I'd be curious your guys' opinion, like what is enough to say we're like moving the needle from like a societal change and opportunity? Obviously, we could go to Amazon and open an Amazon fulfillment center. Not that maybe that's the best option, but it's coming to my brain in another country, and that's going to provide a ton of jobs immediately, but it might not be the way we want to do it. So what's kind of what do you guys view as a sweet spot for that?
This is something that we wrestle with and determine. I'm very analytical by nature and trying to quantify our investments that are, achieving the highest and best return. Both, we look at investments from a financial return is pretty straightforward, but from a social and spiritual return, we're trying to make sure that we're deploying capital in a meaningful way, and it's achieving our objectives. Our primary objective is supporting, faith-driven entrepreneurs and have the opportunity to create jobs, right? So every investment's different, and the metrics around making an investment have changed over time. We have an internal system. So a few years after doing this, we sat down and started looking at our investments and how they performed. We plotted them on a chart. We've shared this in previous forums. Many people may have heard of it before, but it's we marked our investments, or we graphed them how we expect them to perform financially on a chart, or on a 2x2. Financial being the lower axis, x-axis, and then a social spiritual return, or our anticipated guess at how this investment would go on the y-axis. And then we plotted the investments that we had at the time, and we kind of saw two different groupings. One in the upper right, which is the more traditional impact investment category, where it's expected to get a high financial return and a high social and spiritual return. But then we also saw this category of investments in our portfolio that was in this left upper quadrant, which is high social spiritual, but low financial. And we felt conflicted by that. As investors, as people who are trying to achieve excellence, how could we be investing in deals that aren't, achieving the best maximum financial return possible? And so it was through counsel of many other folks that's spoken into us, and just kind of our own introspection, that we feel called and compelled to seek investments that are advancing the kingdom and doing wonderful, great work that aren't always prioritizing financial returns. So that's kind of led to shaping our framework, or how we're going to deploy capital kind of moving forward. So we now intentionally seek to allocate capital in these two different quadrants. This, upper right quadrant that we call maximizing talents, trying to get the best of both worlds. And then this other quadrant, which we call spirit-led, which we believe we're mobilizing capital in more difficult deals that otherwise can't justify themselves on purely financial. There needs to be something else there that's driving the reason for making that investment. And so we're at the early stage of trying to say how many jobs or how much impact drives a certain amount of capital, and we don't have the answers yet. We're trying to decipher, but so far it's just been, are we connecting with the entrepreneur? Do we believe in their mission? Do we feel like they're doing important work that we could support? And we've just kind of analyzed
and
it.
That's awesome. And we can
far.
put a link in the show notes to that graph that you guys have. I was talking to Amy the other week, and she referenced, we're trying to build a similar-ish graphic, because I keep having a revolving door conversation with different people. And I was like, I need some sort of graphic to plot this out. And that's fairly similar and slightly different. So maybe after we record, I'll share it with you guys and get your feedback on it. But I think it's helpful to see that stuff, because it is a confusing space. When I was building the graphic that we were doing, I had 8 data points that I was trying to get onto the same graph. I was like, how do you even concept it? And we just had to choose the ones we do and don't share, but it's so complex, right? There's so many pieces. We try to boil it down to make it understandable. And then at the same time, there's so much going on inside the business mind and the spiritual heart of the person making that investment that it's almost impossible to get it perfectly plotted on a graph. So we'll definitely put that in the show notes. How have you guys wrestled with, we talked a little about this before also, Tom, but maybe not share the number, but obviously your guys' fund isn't charitable capital. So there's people people you guys work with, that we work with, that, all of their capital they're deploying is charitable capital. They've already received a tax deduction for it, and they're kind of putting it out, and they're figuring out where they fit in those investments, right? You guys have said, hey, we're going to run a excellent fund. And it's not all charitable capital. That's correct, right? Not all of your fund is charitable capital. Okay.
Yep. We use both charitable.
So you guys have been challenged with the decision, much like a lot of people getting involved in this space. You guys are challenged with the decision of how do we carve that up? We've got the graph. We know there's projects on both. We know we want to present to both. And how do we find a financially viable split between the two that also has the impact that we want? Talk to me about how you guys wrestled through that piece. And again, you don't have to share with where you guys landed, but I think that's tough, right? You're essentially, we've thought at times about getting a fund together, and I'm like, okay, well, if we were to do this, how do we do that? So share with me those pieces.
I'll take a swipe at that.
Whoever wants to go first.
Well, first is, with Christians, the challenge is that we start with a premise, and it took us a while to get there, Ryan, candidly, is that these are not our resources. Okay, I know that's easy to say, but then when you have a wealth event or something significant that provides resources, it's easy to fall into the 90-10, and we just tithe the 10. And it took our family a little bit to get used to the 100% is not ours. So now when you take an impact foundation or a donor advised fund, it's now not only yours, it's not yours anyway, but it's legally not yours. So it's double down not yours. So in our family's case, we still consider those our resources that God wants us to steward to the best of our abilities. So some families choose to take the riskiest investments and use their charitable capital. In our case, we've not really put a hard line in the sand because we want that capital to do well because we're granting that away. So what we try to do is look for partners that we're granting to. And we always ask them, what can you do to create your own revenue? Almost every person we grant to, what are you doing to generate your own revenue? Because it's a really hard world to go out every day, asking for money. It's brutal. And when they do have ideas, we loan to them generally at low interest, and we use our granting dollars from Impact Foundation, if you will, to do that. But there's no hard line in the sand. So we've done high risk investments in our personal fund, which we refer to as our HIS fund because it's his resources. And then we also grant capital, and we loan money from our Impact Foundation partners where we house the money and into a grantee. So it's a little bit of both. But it starts with a premise, and why everything's different is it's not our resources either way, legally or as a Christian.
Yeah. Tom, you had your hand up a minute ago, or you had thoughts on that too. What were you going to throw in there?
Yeah, this has been a journey for us, something that we're continuing to, work through and understand as a family. But one of the things that we're excited about is getting an opportunity to meet with other folks that are interested in the space and help them think through how they could invest capital. I think as many Christians, it's easy to think about granting to ministries is kind of like your kingdom bucket. That's the side of the ledger that you focus on, really important work. But unfortunately for most of us, we don't have access or ability to invest, use our capital, invest from a kingdom lens. And so what we're really excited about is getting to open that side of the world to families that are interested in leaning into this impact investing realm, to learn that they can use a portion of their capital, both in the philanthropic capital that's in a donor advised fund, or capital that's sitting, on the other side of the ledger that can really do important kingdom work. And, we're excited.
Right, I want to add just one other component, and we have a graph that we use when we present all the time. And that is, you probably know, or maybe your listeners know, that roughly last year, $471 billion was given from the United States to appropriate charities or ministries. The impact investing business, which is not your SRI or ESGs that are in public equities, but your impact investing, which are direct investments, those type of things, is sized by various people at about 715 billion. But they just started that in the last half a dozen years. And the problem with the granting capital side is it's been fairly stagnant, although it went up 5%, as bigger increases it's had in many years. And they call it the stubborn giving curve because it's been relatively 2% of GDP for 40 years. And where all the money is in the investment world. You could argue whether it's 100 or 150 trillion, but it's not 470 billion. We aren't going to solve the problems with that 470 billion. We could talk all day. It's just not going to happen. So you have to get at this investment capital, and whether you use the $1 trillion that is currently sitting in DAFs and foundations right now that could be used more purposefully, or your other capital that you have in your family. That's the only chance we have of solving some of these problems. The only chance.
Yeah, totally. I mean, and there's so much money available for that. I mean, as you guys are talking, like, I think often, like, we did this event with Impact Foundation and NCF South Florida last week in Fort Lauderdale that we were talking about. And we focused really heavily on Impact Foundation because everybody there had a donor advised fund. And at the same time, I was like, hey, I just want to clarify this project over here, raising equity with like an exit strategy in the next 3 to 5 years. Like, don't I almost want to tell people like, don't just think impact foundation, because you can take your charitable capital, but you've probably got your normal investment portfolio that could be a good fit for this. And it's going to some other company that has an exit strategy in 3 to 5 years that might not be displaying the same kind of values that you uphold. And so I think there's that whole side of it too, that we often don't even, it's easy to get narrowed into the charitable capital piece. I think that's something you guys have done well with your fund, is it's like, we talk charitable capital, and that part's, I mean, Amy and the team at Impact Foundation have just developed it so well, right? It's very prevalent in its opportunity, but then there's, man, like, how can we do better with our normal investment portfolio, and are there opportunities there? And obviously Faith Driven Investor and Henry and them are like, they're doing a lot of that kind of stuff too, which is really, really powerful what they're doing.
Yeah, Faith Driven Investor has been a great resource for our family and for others. They've done an awesome job creating a podcast and an online marketplace for access for folks that are looking for investable deals right now. And I would encourage anyone listening that hasn't looked at their resources. It's a great place to start.
Yeah, totally. All right, everyone, I want to take a quick break from today's episode and just share a little bit about Impact Foundation, who's got an incredibly awesome model of using impact investment, charitable dollars, and funding tons of projects all over the world right now. What if your investments could change the world? At Impact Foundation, they believe business with purpose has the power to transform society. Purpose-built for impact investing, Impact Foundation provides a streamlined way to fund businesses that seek social and spiritual transformation or make loans to charity, all while earning a financial return to grow your giving. Donors and investors have already supported more than 200 redemptive enterprises through their impact accounts. They provide needed fuel for companies that exist as a force of God's redemptive work in the world. To learn more about what they're doing in their kingdom impact investing model, visit impactfoundation.org. So on that FDI track, something that I've seen, or that I feel has happened, like you've got kind of I think you guys maybe experienced this. I've talked to someone that we talked about earlier that we know that I won't share their name, that looked at a lot of projects with you guys over time. And there are a lot on maybe the FDI marketplace, the types of projects that attracts that might not have been a great fit from the ministry side. I usually have seen that a lot of like the FDI world, I always explain it, and this is going to be a bad, and Vip's been on the podcast. We talked about this a little bit, but like, it's kind of like, oh, I'm in VC and I'm used to VC, but I want to get a more like a Christian or ethical CEO that's going to treat the employees right, that's going to run this business well, it's going to do good things with the profits and do that. And it allows for that same return. Like, I feel like if you've got VC way over here, you've got your traditional donor over here, the FDI is doing so much to grab that like normal private equity VC person, kind of move them over, get the same returns, but it might not play as well for like the traditional donor moving a little more towards the center of impact investing. And so maybe you guys agree with that, but I guess, what are your thoughts on that? And also, how do we get the VC minded folks to move a little more to center on that, if that's like a spectrum, right? So it's just a different kind of return and it's a different kind of risk, right? So how do we balance our mindset of going and getting those private equity and VC dollars into this space a little more intentionally or successfully, I guess?
It's going to be a battle. Almost all of the capital in the world is financially driven on the returns. So as soon as we have many people in our networks that are raising capital, that are trying to raise social funds, that struggle as soon as they bring up any hint of a social impact, the automatic instant thought is that the returns, the financial returns, will have to be impacted. They have to be reduced.
Which isn't always true.
And it isn't. There are incredibly successful, huge social impact and spiritual impact deals that have outsized financial returns. But the general public opinion is when you add social, the financial returns drop. And so getting around that stigma and understanding that if you're seeking the highest financial returns only, you have a great resource. There's a ton of opportunity to invest in market returns that have social impact.
Yep.
And that realm should be attacked and addressed first, because it's the easiest low-hanging fruit. That if you're not investing in for a social business, that's a great place to start. There's the whole other realm that Greg mentioned earlier. There's a lot of capital sitting in donor advised funds or foundations that's been shifted over that says we're using that for a mission of some sort, either faith or social. We're trying to use this capital from a lens. Well, right now, 95% of it, right, if they're only granting out 5% every year, 95% of it's sitting in a mutual fund or something that's not missionally aligned to the source or the impact of the foundation. That capital is also low hanging fruit that should be invested in social businesses, and is starting to, but it's not nearly as much as it could be.
Yeah. Well, I think sometimes it's people aren't even thinking about it. Like a large percentage of, I mean, I don't know the numbers of how it shakes out, but a large percentage of the money out there in the world, like that people hire a financial advisor, they're making an average salary. They get a financial advisor, they do their 401k, they put money in a mutual fund, they're focusing on retirement. Like that whole portion of the money, like a lot of those people just give it to the financial advisor and they put it in a mutual fund somewhere, and it's just kind of done and sits there. Like they're not really thinking about using it that way. Now, obviously that doesn't represent the, billions of dollars of people that with like extreme wealth that are putting it in those things. But that alone, Tom, is like you said, it's a lot of low hanging fruit that could be just thought about differently. And I think
let me make a couple of comments.
Yeah, go ahead.
Sorry, right on it.
No, go.
In that, read an article yesterday and another article recently that the millennials and your generation, et cetera, are not going in droves to financial wealth advisors at the moment because they're very conscious about what they want to invest in. And one of the challenges with financial wealth advisors, because they're your fiduciary, they really can't bring these deals to you.
Yeah.
They can't vet it. It's too much risk. No one, they're going to hold them accountable. So the last place, unless you're doing a public equity, so SRI or ESG for environmental social governance, they can bring those to you. And our wealth advisor has on the public equities. But private deals that we're talking about, even really good funds that we're talking about, you can't get them through your wealth advisors.
Yeah.
So they have to go outside of that on their own and say, this is important to me.
Yeah.
And I wish I could say that the Christians are leading here. I don't believe that they are. In my experience, the Christians have a higher bar than the secular people we deal with. And so if I was to present making numbers up, I could come to you and say, hey, Ryan, I got a great investment. We're going to hire 10 Ivy League grads and they're going to do really well and it's going to get you a 20% return. And you saw, geez, that's really great. And I go, but I got another deal over here that's a 15% return and we're going to hire 50 artisans in Haiti. They're going to feed their families, but I'm sorry, it just doesn't support a 20% IRR.
Yeah.
Which one do you go with? So now I know those Ivy League people are going to do pretty well. And they'll say, well, maybe I'll do it if it's at 19.9, but I'm not willing to go all the way down to 15. And you could change the lives of a community for slightly less. And so I know this isn't talking about risk-adjusted returns. These are slightly less than risk-adjusted returns, but it's stuff that people, especially Christians, should be challenging themselves with some portion, not all, some portion of their capital to use.
Who's doing the work of having that tough conversation? Like that takes... I use the word discipleship, we're used to that in a biblical context. Like it takes discipling and mentoring. Like, I mean, just to navigate that. We've had a couple of people come to us, probably 3 or 4 now that we just know in our network of say, hey, I just came into some money. Like, and I love what you guys do. And I love this impact invest. Like, can you help me even just think about this? And we could probably just make a whole business model around like, how do we as thought leaders in this space, like, help that? I mean, obviously FDI is doing a lot of that, but what do we do as people who have an opportunity to like get more people involved? Like the financial advisors aren't doing it. And honestly, most of the people you're talking about, Greg, aren't accredited investors. So it's not like they're even like, you know, going out and looking for angel investment. I mean, very low percentage of people we're talking about have ever made a sizable deal like that, and they might only have 5 to 15 or 20K a year of capital they want to put into something like this. So they'd have to pool it together to make an impact. So, it's a big open-ended question, but like, what do we even do with that? Like, we know it's a problem, but what do we do about it?
It's unfortunately a big problem that we can't and haven't solved. It's a big problem because most people have no access to invest in the deals that is required to be invested by accredited investors. Like there's just simply, there's a lot of millennial audience that will have the interest to invest in deals, but then they just have no means or mechanism to do that. And I have not found a great resource for allowing, folks to invest $500 or $1,000 or $5,000 into really high impact deals. It's not been something that I've seen. You could do it from a stock portfolio and, screen against negative impacts, but not really proactively investing. It's unfortunately, in the landscape that I'm viewing, it's just not out there.
Yeah. The only thing I've seen close to it is like what WeFunder and all those do with like the Reg CF crowdfunding kind of stuff. But man, we've had one and kind of two projects use WeFunder now. And I love the Reg CF stuff. I think the whole idea of like $100 to $1,000, but I don't know that that's the answer, but it's like the closest you could get to it. The other would be pooling those investors together into one fund, but then the amount of work that would take for a fund manager to pull that together, you're going to especially on these kinds of projects.
No, Impact Foundation offers a really nice, they're the only ones on the cap table. So we've done some deals where 6 or 5 or 4 other families come together, and the minimum at Impact Foundation, I believe, is 25,000. And so when you bring a syndicate of people together, you can get to that very quickly or more. And it's only one investment from Impact Foundation. So it's very easy for the company you're investing in to do that. Now, it's not as easy when you're not using charitable capital, because most of the product on the shelves are more expensive than the average consumer. And that's a problem for our industry. And so all of us, you, I, Tom, need to help get products on the market that allow everybody to invest in it, not just people that have more wealth, because it's going to change here in the next 10 years. The younger generation is going to demand access to products like this that they can invest in, because they believe so much in the social impact.
Yeah. It's super interesting, and one that, obviously based on this conversation, once we stop the recording later, I keep brainstorming with you guys on it, because we're all passionate about it. Like, we want to see it grow, because that's the kingdom growing in some cool ways. So this is shifting gears, and it's not. Let's talk about exit strategy a little bit. So a lot of the projects we work with, like, they don't have the clear VC private equity kind of exit strategy. We're like, hey, 3 to 7 years, we're going to sell on X multiplier and you're going to get it back. And let's just, maybe for the assumptions, let's say that VC is used to that, like take the Silicon Valley normal thing, and private equity is taking over some sort of management responsibility. So they're wanting way more equity. A lot of these impact focused projects, they're not, a lot of them don't have an exit strategy that really makes sense for like a firm exit to be acquired or something like that. And a lot of them, from a missional standpoint, there's no way they're giving up that money to some or that ownership stake. They're very protected impact wise around the equity ownership standpoint. So where someone might say, hey, the private equity can have 51% ownership because they're going to bring it in, I'm going to make a lot of money. And if if they go sideways on the management or something, or we get an argument, like I'm still fine. That's not, there's a whole nother realm with these impact projects. That's not even an option for them to do it. So what happens a lot of times, it just ends up as a loan. It's like, we'll just do a loan at a somewhat competitive rate. Or sometimes it's a profit distribute, like a dividend drip over time that just kind of looks like a loan. And then having people on your cap table at X% equity that are just getting a dividend at a low rate, like, kind of is pointless after a 20-year timeline. So then it just looks like a loan anyway. So you guys are smiling because maybe I'm stuck in it more because I'm helping all the projects. Like, we look at the financial model, we have to figure out the type of structure and all that stuff. And then you guys see it on the back end, but like, how do we think about that side of it? Or what are you guys seeing, or what are your thoughts on that whole thing? I didn't really give you guys a layup question, but I gave you the, word vomit of what it feels like to deal with it all.
Yeah, it's having over 100 investments over the last few years, we've invested in every structure and style that's ever been created. We've got equity and convertible notes and loans and all sorts of different stuff. So we've seen it all. As we look at new investments, like as we go forward, what we're trying to do is invest, particularly if you look at maybe the international market, where it's harder, as you mentioned, to get, particularly in a social business, a private equity firm exit, something that creates liquidity that makes an investment worthwhile to, financially driven investor. So we start with the lens of what's best for the entrepreneur or the business. What mechanism, what funding structure are they seeking? And then how do we pair into that picture? Because sometimes they're looking for an equity position, and equity just doesn't make sense because there's no opportunity to exit. So then that maybe doesn't work. And so we try and get creative, but we usually start from the framework, what's the best thing for the business? And as we've chatted with other entrepreneurs, the best way, particularly from an exit perspective, that I've heard it articulated is entrepreneurs who have a social business should steward that business as long as they're the best steward of it. If the business is structured in a way that its profits or it's the way it generates income is in line with its social benefit, if you sell more hats, you employ more people, so more selling is better for your impact. Kind of a logic. If you then sell that to somebody else who can grow that and then ultimately sell more hats and employ more people, that's a position where you're not transitioning the business to where you're extracting the impact. If there are usually when we evaluate opportunities that say, I'm going to sell a bunch of somethings and then use all the profits from that to support a ministry over here. And that's great. We encourage that. And that's wonderful. More businesses should do it, but the impact is, as you mentioned, against the profits. You have to use the profits to support the impact. And we try where we can to find businesses to invest in that the mission and the revenue source kind of line up.
Yeah. It's almost like the programmatic expense is above the line by the nature of the business, right? And above the line, meaning it's in the cost of goods sold somewhere. Yeah.
So it's not an easy answer. Any entrepreneur that has a social enterprise that they feel passionate about will struggle releasing, all the hard work that they put into it and then trusting that somebody else will be able to continue to sail the ship in the way that they wanted to continue. But it's a good problem.
How much do you guys think it changes the risk game? So if this is like let's just say, the number of businesses and entrepreneurs that get a successful exit is small, right? So we take the hundreds of thousands that are going to try to do that this year, and we nail it down to, let's just say 5% of those exit, right? And now with these impact ones, we're saying, okay, of those 5% that exit, I'm only going to give it to some, like, let's just say they're saying, I'm only going to give it to someone who's going to run it on the same ethical values. So if we're talking in the Christian space, like most of the time that's another Christian private equity firm or something that's aligned. I mean, that trims those acquirable companies down quite a bit. There's a few other factors. I won't go into them, but I guess the other acquiring companies would be if the impact, it would be companies or private equity firms that are open to acquiring something that they're going to have less profits due to the impact in some way, right? Not that they're working against each other, but realistically, they're just thinking about doing that. So the point of my question is it even, how realistic is it for us to look at the impact investing space overall and say, yeah, you know what, exits make a lot of sense? Because we're already saying it's a super risky investment because the chances of it happening, I mean, VC private equity funds, what they say, like 1 out of 100 pops and they're happy sometimes, right? And now we're saying it's like 1 out of 1,000,000 or 1,000 or something, just because it's so much more granular. I could try to restate that if you're not tracking with me, but how much differently do we approach that risk as, I guess, Christian social impact investors looking at that side of it for traditional exits?
So the best framework to start here is, the traditional venture capital fund will try and, let's just say, invest in 10 to 20 deals. They know that half of the deals are going to fail and return nothing. A portion of them will give them some returns, and 1 or 2 are going to do well that'll drive the returns. And those 1 or 2 under the traditional venture capital funds need to return 30 or 100x in order to make all the losses work and they can generate returns. That's just, purely financial venture capital. As in this impact space, or particularly as it relates to our fund, most of the deals that we're investing in have no opportunity to generate a 10 or 30x return ever. There's just not a market, as you described, to exit in that fashion. And we probably know that the likelihood that these businesses aren't going to survive for 10 years or more is probably worse than 50%. So we go into this nature going, we're following a venture capital style fund where we may have the same number of failures, or failures in the term of that they aren't able to survive. They could be tremendously impactful for the life of the duration of the business. But we don't also have those same opportunity to create the large financial returns. So it's a challenging and difficult situation, because there's no, it sometimes creates us in a position where we're investing in businesses where the risk doesn't match the potential financial return. But we have the flexibility with our structure to be able to deploy it, not based on financial returns, but based on social and spiritual returns. An opportunity. We know the businesses that we're investing in are doing incredible work, and we want to support them as best we can.
Yeah,
I think we have to get the conversation off of just financial returns. We're not afraid of those. If you go back to Tom's discussion on our quadrant, in our 2x2 in the upper left is higher social, spiritual, lower financial. Who would ever be there? Well, we're there. And we believe Jesus would be there. We don't believe that his timeline is 5 to 7 years. And we don't believe he says a 25% IRR is what you have to perform to. So his timeline is eternity. He's with the widow, the orphan, the marginalized. Why would we not, at some percentage of our investments, be in that space? So it's okay that their returns are lower. We're going to do just fine as our fund. We're going to have some high risk, lower returns than risk adjusted lower returns, but we're too focused on just IRR. And that's one of the challenges that, in our family, when you look at this quadrant, I always tell people, so when you're in the upper left and you're looking at a deal, and let's just say it returns 8% over 6-8 years, and it's a really good, socially impactful spiritual deal. But then you hear from a friend that there's a 10% one, and you go, oh, okay, maybe about 10% one. And then a friend of yours told you there's even a better deal in Africa, could be 13%. And what happens is you slowly come out of that quadrant and you're pulled naturally. I don't know if it's demonic or by the devil or by just greed or power, and you slowly get pulled to the higher RRR because it's just easier. If you're going to take risk, I want the highest IRR. And our family we have a goal of 50% of our deals that we invest in that upper left-hand quadrant. And they're the ones we're most proud of, but they're not risk-adjusted returns. That's why we call them spirit-led. They are led by the Holy Spirit. We can't justify it just on financials, but they're doing quite well, I would tell you. They care more about sustainability and human flourishing, and they're less concerned about scale. They're concerned about just staying alive and providing opportunities. And we like being in a partnership with them. So it can't be just IRR, Ryan. I think that's the biggest problem we all deal with. It just can't be, or at least from a Christian lens or a Lernihan Christian lens, but we don't think it can be.
Yeah. Well, and part of the reason I'm pressing it with you guys, I think we know that most people, that's where they're sitting right now. And so the more we can talk about it and move that, it opens up the doors for them to come over to that spirit-led side. Right. So it's, I
will tell you that there are many people that disagree, rightfully so, with our philosophy, and will say, if you invest in a lower risk adjusted, it's going to have some appreciable, whatever it is, lower percentage, you are hurting the impact investing space. You're investing in bad deals. We just don't believe that when you put a lens of Jesus on it, in that you can't convince us that he would not be with the widow, the orphan, and the poor. You just can't.
Yeah. Well, and I don't hear you guys saying that it's black and white, right? I hear you guys saying, wow, man, there's some over here and some over here and then somewhere in the middle. And we need to put some guardrails on ourselves. We've done the heart wrestling and the financial wrestling, and we know what our guardrails are to keep us on track. And that also leaves us the freedom to let the Holy Spirit work in there. Maybe the other way around, where the Holy Spirit is giving us freedom to move, and we have to put guardrails on ourselves. So we stick with that. And I think that's important. I think where you guys will land on that might be different than the person down the street. And if it's done in wisdom and it's done in prayer and it's done in all those things, and that's okay that they land in a different spot, because there's going to be projects that fit them better than you guys and vice versa. And I'm hoping that this space moves to there. As we kind of close our time out, talk to me about where do you guys hope in the next 5 years? Like if we're having this conversation 5 years from now, where do you hope that this space, everything we've talked about is, and maybe that's just a quick clarifier of what it looks like, or it's a dollar amount or something. And what do you think is the number one actionable thing that we can do to get there? And you guys can both share your thoughts on that.
Well, just from my perspective, so much has changed, both from our own internal family's investing policy in 5 years. That time horizon feels like it's approaching quickly. But I hope, if we jumped out to 2026 or around that time horizon, I'm hoping that impact investing as an industry is continued to follow its trend and grown substantially. I'm hoping that more Christian families are aware of the opportunity to use their resources, not just charitably, but also from an impact investing, that they can invest from a kingdom lens. And I'm hoping we get better as a fund and as a community of faith-driven investors, that we have a system and resource in place to deploy capital meaningfully and impactfully, and in a way that supports the growth of the kingdom here, that can employ and create jobs and sustain impact in communities for years to come.
Yeah, that's awesome.
I would agree with everything Tom said. I would hope that we have better measurements that I've always struggled with. My example I gave you on, the Ivy League people getting jobs, or you could, I think it was 50, whatever number. I've always wanted to try to figure out, what is one marginalized job worth? Is that worth 1/10 of a return? And what if we could hire 500 people? Or would you take 0.2% less in return if we could really prove that out? I hope our impact measurements somehow can justify that there's more there than just a financial return. And I can't remember, I'm blank, you can help me out here on it's been around for 100 years, where he said the number one thing is shareholder value. What's the name of the guy that said that 40, 50 years ago? We're only here, and it'll come to me as soon as we hang up on the podcast, we're only here for shareholder value. It's not Sigmund Freud, but it's on the tip of my tongue. I'm hoping 5 years from now, and it's all companies are saying that's no longer, they're here for colleagues and customers, and shareholder value is only a component. I hope we're looking back and they're saying the number one thing is spiritual and social returns, and then financial returns, not the other way around. I hope that that's changed. And I hope that Christians are leading it.
Yeah.
I think right now we're following it. I hope they're leading, and they're bold, and they're willing to take the risk for the kingdom.
Yeah. Yeah. I love that. Yeah, and that's needed. And I think part of what you guys are pointing to there, that I draw out is there's a data science side to this that we just don't have yet. Like, this is still a young kind of idea. It is and it isn't, but we just, in 5 years, the amount of projects that'll be invested in and the success rate of them and how we can track the metrics and all that will just mature to a point where we can just better plot them on that graph and know what works and what doesn't work. And I'm excited for that. And you guys are going to have way more data next year than you do now, because you'll see some of those coming back. So, well, guys, thanks so much for joining. This has been an awesome conversation. It's something that's obviously on top of your mind all the time, and it's been on the top of mine for a long time. And so it's just good to chat and connect. And I'm thankful for what you guys are doing and the thought leadership you're providing to the space too, which is pretty cool.
Ryan, thanks for having us.
Grateful for the opportunity, Ryan.
Grateful to be here and appreciate the work you're doing.
All right, everyone. Thank you for listening to another week of the Feast Over Famine podcast. We are so thankful you guys are here and listening. As always, hit that subscribe button on your favorite podcast listening apps. We would love to keep you guys up to date on new episodes that are coming out, when we're launching new episodes, when we're launching new seasons, and everything in between. So when we're in season, episodes are dropping every single Wednesday. Hit that subscribe button. Make sure you're up to date. Also, if you're loving what we're doing, be sure to follow us on Facebook, Instagram, LinkedIn, where we're constantly posting about our projects, what they're doing, what kinds of things we're working on. We'll recycle some podcasts, things about our partners, all sorts of fun stuff that you want to see. So hit us up on Facebook, Instagram, LinkedIn, all that kind of stuff, and check out what we're doing there. And yeah, we're stoked that you guys are listening. We hope this has been really fruitful, and we will catch you guys next week. And lastly, as you guys all know, we always talk about all sorts of things with impact investing, investment opportunities, entity structure modeling, how projects are getting capital. And as a disclaimer and a reminder, Feast Over Famine does not provide legal, tax, accounting, or other professional advice. You should consult professional advisors concerning the legal, tax, or accounting consequences of any activities related to your project or a project you're supporting. Feast Over Famine doesn't consult, advise, or assist with the offer or sale of securities in any capital raising transaction. We don't do that for the direct or indirect promotion or maintenance of a market for any securities. And Feast Over Famine does not engage in any activities for which an investment advisor's registration or license is required under the U.S. Investment Advisors Act of 1940 or under any other applicable federal or state law, or for which a broker's or dealer's registration or license is required under the U.S. Securities Exchange Act of 1934 or under any other applicable federal or state law. So there's your investment disclaimer. Hopefully that's helpful if you need it. And if you ever have any questions on that side of things, don't hesitate to reach out to us. Take care.